Testing 1, 2, 3, 4, 5.
Okay. Welcome. Welcome to CFS members and friends, the media, and a special welcome to Federal Reserve Board Governor Chris Waller. It's truly a pleasure to have Governor Waller with us. Thanks to him for offering remarks and for participating in a discussion with us today. Most importantly, we appreciate his leadership on the Federal Reserve Board, an entity of great importance for our nation since 1913. History and the role of financial institutions has been a cornerstone of the work at the Center for Financial Stability since our founding. With our publishing Kurt Schuler's The Bretton Woods Transcripts, and our hosting working group meetings motivated by the tremendous work, international monetary work, and achievements in the White Mountains of Bretton Woods, New Hampshire. Yet, our work is all about the future, identifying financial risks and opportunities, delving deeply into data with our advances in monetary and financial measurement program under the leadership of Professor William A. Barnett, and with our focusing on technology and how technology will continue to revolutionize the future of finance. We are truly at a historic moment. Hence, it is a great privilege to have Governor Waller with us today. Prior to his appointment at the board, Chris served as Executive Vice President and Director of Research at the St. Louis Fed. Under his leadership, the research department published papers in top-notch economic journals, as well as within and throughout the Federal Reserve System. In addition to research, policy, and academics, Chris and the team at the St. Louis Fed did an absolutely magnificent job of growing the Federal Reserve Economic Database, or what we affectionately call FRED. FRED has provided enormous value and benefits for many officials, academics, and practitioners alike. Before that, Chris served as professor and the Gilbert F. Schaefer Chair of Economics at Notre Dame. It is also a pleasure to have CFS board members Joyce Chang from J.P. Morgan and Peter Flokas from the University of Pennsylvania Carey Law School with us today. Thanks also to Crypto Dad, or former CFTC Chair Chris Giancarlo, who has been gracious and shared his perspective on cryptocurrency and the coming digital economy. Before turning it over to Chris Waller, a few organizational items and issues. First, as the pandemic remains with us, masks are available, but optional. Second, the meeting is being recorded and simulcast live. In terms of the agenda, Governor Waller will offer remarks. I will follow with questions. Then we will encourage questions from participants. If you have a question, please raise your hand, identify your name and institution, as well as clearly and succinctly asking your question. After the event, Chris has graciously agreed to remain with our group for a while to meet and to connect. Governor Waller, thank you. Thank you for being with us today.
Well, thank you, Larry. Well, thank you all for having me. This is my first live speech since I became a governor. I'm used to normally having a slide deck, PowerPoint, walking and talking and just talking off the top of my head, but board staff freak out whenever I talk about doing that. So I'll stick to a written speech today. So it's a pleasure to speak today at the Center for Financial Stability, and I look forward to our conversation. Let me take the next several minutes to speak about the continued improvement of the U.S. economy, recent inflation data, and their implications for monetary policy. I will also discuss the Federal Open Market Committee's recent decision to begin reducing monthly purchases of securities and how incoming data may affect the pace of tapering. Finally, I will address issues concerning the size of our balance sheet. Let me start with my views on the economy. Since I last spoke on the subject exactly a month ago, the basic shape of my outlook hasn't changed. The economy continues to grow and add jobs at a strong pace, making steady progress toward the Federal Reserve's goal of maximum employment. New data shows that employment gains were better than first reported in August and September, and we're back to a strong level in October. But we have also learned that supply constraints, both bottlenecks and labor shortages, are having a larger and more persistent effect on the economy. Due to a combining of those supply constraints with strong demand, inflation pressures are becoming more widespread and may last longer into 2022 than I thought they would last spring. These factors haven't dented my optimism that the strong recovery will continue, but have raised the risk that supply constraints may limit job gains and output growth, and that inflation may complicate the FOMC's management of monetary policy in 2022. These factors weighed on output growth in the third quarter, which is down considerably from the 3 months before, but which I expect will rise again to a strong rate in the fourth quarter. The explanation for the downturn is the same story we have all been living through since March 2020, the ups and downs of the pandemic. The Delta variant and supply chain problems threw the economy off the very strong growth track in the third quarter, but I anticipate it will return to that path in the fourth quarter. As society continues to learn how to manage the disease and ever-improving treatments reduce the likelihood of death and hospitalization. Assuming another damaging COVID-19 variant does not arise this winter, I expect gross domestic product to resume its robust growth not only in the fourth quarter of 2021, but also in the first half of 2022. In terms of the job market, households and businesses perceive that conditions are as tight as or tighter than they were pre-COVID, even though the unemployment rate is still more than a percentage higher than it was in February 2020. There are certainly ample data showing labor demand is very strong. Job openings remain at a record level. New businesses are starting up at a much higher pace than they did from 2017 to 2019. People are quitting jobs, either to take new ones or because they are confident that they can find new ones. Likewise, a record. The improvement I expect to managing COVID should drive demand higher, but also provide a boost to labor supply as those who have been on the sidelines return to a job market that keeps improving. With respect to employment data, revisions to the August and September job numbers indicated that the summer slowdown in job gains wasn't nearly as bad as initial reports suggested. Job creation averaged 442,000 a month from August to October, down from 641,000 average for the prior 7 months of 2021. Nevertheless, 442,000 is a healthy pace for job creation and will speed the recovery of the labor market if it continues. Now, adjusting for early retirements, which are about 2 million, we are only 2 million jobs short of where we were in February 2020. That's it, just 2 million. Regarding the unemployment rate, in October, the rate stood at 4.6%. Compared with 1 year ago, that rate has fallen 2.3 percentage points. If the decline continues at about that pace in the coming months, the unemployment rate could be below 4% before too long. In light of these data, in my view, the labor market is rapidly approaching maximum employment. But I will be watching for factors from continued supply bottlenecks and a winter surge of COVID cases that could slow down this progress. Turning to inflation. Inflation has escalated substantially this year, as we all know. along with a significant rise in inflation expectations. The October Consumer Price Index report showed an unexpected surge in inflation. The monthly print corresponds to an annualized rate exceeding 10%, while the year-over-year increase was 6.2%, the highest since December 1990. Despite the highest wage gains in years, inflation this year has wiped out any real wage increase for the average worker. High inflation is painful to Americans who have little choice about the goods and services they buy for everyday living. Prices are up significantly at the grocery store, which is a major problem for many individuals and households. Unlike earlier this summer, price pressures are no longer concentrated in a few categories. They appear to be broadened. There has been a notable increase in the prices of energy, food, goods and services, as well as the cost of owning a home. Even trim mean measures of inflation that exclude some big price movements, positive and negative, such as the Cleveland Fed and Dallas Fed measures, report inflation rates above the Fed's 2% target. Diffusion indices of price changes, which are often used in detecting turning points in the data, show an increasing number of categories with 3 or 12-month inflation exceeding 3%, compared with earlier data this year. Now, I expect that these pressures are related to both supply constraints, which may be beginning to improve, and strong demand, which shows no sign of abating. Wages continue to grow quickly on a more sustained basis than they have in more than 20 years, most recently reflected in a striking increase in the Employment Cost Index, which considers both pay and benefits. Wages and employment costs seem to be widespread across industries and among businesses of different sizes. Crucial to the path of inflation will be whether we see input cost increases consistently reflected in final goods prices. Our business contacts report that companies are comfortable passing along these cost increases to their customers. Now, it has been argued that because price pressures connected to supply constraints are transitory, the dreaded word transitory, they will come to an end. So monetary policy does not need to respond to temporary price increases. I find this argument puzzling for a few reasons. First of all, shocks tend to be transitory and eventually fade away. So by this logic, the Fed should never respond to any shocks. But it sometimes does, as it should. Second, the macroeconomic models we use to guide policy typically have cost shocks built in that cause inflation to move. In those models, appropriate monetary policy responds to these inflation movements. It doesn't ignore them because they're cost shocks. Finally, the choice to take a policy action depends on how large the shocks are and how long they are expected to persist. To make this point clear, consider a snowfall, which we know will eventually melt. Snow is a transitory shock. If the snowfall is 1 inch and is expected to melt away the next day, it may be optimal to do nothing and wait for it to melt. But if the snowfall is 6 to 12 inches and expected to be on the ground for a week, you may want to move sooner and shovel the sidewalks and plow the streets, even though you know it's going to melt. To me, the inflation data are starting to look a lot more like a big snowfall that will stay on the ground for a while, and that development is affecting my expectations of the level of monetary accommodation that is needed going forward. Now, inflation expectations on the part of the public also play a role in the conduct of monetary policy. 2 surveys of consumers by the University of Michigan and the New York Fed show median inflation expectations running over 4%, and bond investors are requiring over 3% compensation for future inflation and inflation risk. It is very concerning to me that households and markets are no longer expecting us to keep inflation near our 2% target over the next 3 to 5 years. Now, it is true that there's some evidence that these consumer survey measures of future inflation tend to move around a lot based on changes in current inflation. So I hope these large movements in inflation expectations are, wait for it, transitory, and will come back down as bottlenecks and labor shortages resolve themselves over the coming weeks. But if these measures were to continue moving upward, I would become very concerned that expectations would lead households to demand higher wages to compensate for expected inflation, which could raise inflation in the near term and keep it elevated for some time. This possibility is a risk to the inflation outlook that I'm watching carefully. So what are the implications of all these considerations for monetary policy? The economy made faster progress in 2021 than most of us expected back in December 2020. This substantial progress toward our dual mandate goals allowed us to begin reducing the $120 billion a month in asset purchases that were aiding the recovery by steadily providing accommodation to financial conditions. When we started tapering a few days ago, it happened several months earlier than was expected by market participants in the early months of 2021. We cut both the amount of Treasury security purchases to $70 billion per month from $80 billion per month, and the amount of agency mortgage-backed securities, or MBS, to $35 billion from $40. We will make another $10 billion and $5 billion cut to monthly purchases in mid-December. In the next few months will be critical, however, in determining how the tapering process plays out. The committee has been very clear in the months leading up to our decision and in making that decision that the pace of reducing asset purchases would depend on the progress towards our dual mandate goals. If COVID or some other factor substantially slows the recovery, hindering the progress towards maximum employment, the FOMC could slow its taper. But if the economy makes quick progress towards maximum employment or inflation, data show no signs of retreating from their currently high readings, the committee may choose to speed up the taper, which would position it to accelerate subsequent steps in tightening monetary policy if necessary. The timing of any policy action is determined as a decision by the FOMC, but for my part, the rapid improvement in the labor market and the deteriorating inflation data have pushed me towards favoring a faster pace of tapering and more rapid removal of accommodation in 2022. Another policy action already being discussed in public by market participants is the timing of the first increase or liftoff of the target range for the federal funds rate. The FOMC has described the conditions that must be met to consider liftoff. They are when the economy has reached maximum employment and when inflation has risen to 2% and is on track to moderately exceed 2% for some time. Assuming inflation expectations are well anchored, I judge that the timing of liftoff is any time after both of those conditions have been met. I believe the condition for inflation has already been met, and we are making great strides towards achieving the employment leg of our mandate. I will be looking at the incoming data to determine when we have achieved both these criteria. After that point, whenever the committee ultimately decides to raise the target range for the federal funds rate from 0, monetary policy will still be providing an extraordinary extent of support for the economy. Short-term interest rates will still be very low, and large amount of securities holdings on the Fed's balance sheet will continue to put significant downward pressure on longer-term interest rates. Now, this fact leads to another policy action the FOMC needs to consider: when to begin reducing securities holdings. Now, we're still increasing them, but at some point we have to make a decision about whether to reduce them or not. Now, it is important to remember that the FOMC makes monetary policy decisions with the best interest of the American people in mind, and not based on how those actions affect the size of our balance sheet. Between March of 2020 and today, the Fed security holdings have increased $4.2 trillion to stand a bit over $8 trillion. These holdings are about 35% of the level of annual GDP, real GDP. This percentage sounds quite large, But the Fed's share is not out of line with what is found on the balance sheets of other advanced foreign economies' central banks. For example, our share is larger than that of the Bank of Canada, but it is about the same as the Bank of England's and much smaller than the shares of the European Central Bank and the Bank of Japan. Now, first, one must remember that there is no economic theory that tells us what the optimal size of a central bank balance sheet should be. None. I never taught it in my life. So just because our balance sheet is large does not mean that there's anything wrong with it. However, arguments can be made that we should reduce the size of our balance sheet. First, we expanded it for emergency reasons due to the pandemic. As the emergency passes, we can undo those actions and get the balance sheet down to something close to its pre-pandemic trend. Second, by doing so, we free up balance sheet space in the event we need to expand it in the future to deal with economic shocks. Third, the private sector appears to be inundated with liquidity, as evidenced by the large take-up at our overnight reverse repurchase agreement facility. Draining some of this liquidity would help maintain smooth market functioning. Going forward, the committee will need to decide what type of reinvestment policy to have in place. Currently, when securities on the balance sheet mature, the proceeds are reinvested in new securities, keeping the balance sheet growing in line with net purchases. Under this policy, when net asset purchases cease, reinvestment will keep the balance sheet constant at the size at that time. Now, based on past experience, an effective way to gradually reduce the balance sheet to a more efficient level is to change that reinvestment policy to limit or cease reinvestment. Allowing this runoff was the main way the FOMC shrank the balance sheet before the pandemic. I expect the reinvestment strategy will be heavily influenced by the Fed's experience with this policy between 2017 and 2019. During that time, the FOMC recognized that the monthly maturity of securities was lumpy. Some months there were many securities maturing, and other months there were few. The FOMC ensured a gradual and predictable roll-off of securities that allowed market participants to plan for the Fed's gradual retreat from the Treasury and MBS markets, which was done by instituting monthly redemption caps that gradually increased over time. I would support a similar process when the time comes to alter our reinvestment policy. Now, as security holdings declined, so did reserves in the banking system. In mid-September 2019, upward pressures emerged in funding markets as reserves dropped to about $1.4 trillion, or 6.6% of GDP at that time. Most thought the Fed's balance sheet could be reduced even further. In fact, the median of the respondents to the June 2019 primary dealer survey conducted by the Federal Reserve Bank of New York indicated reserves could fall to $1.2 trillion. But the underlying level of reserves wanted by financial markets seemed to be much more than was anticipated. In response to the emerging pressures at that time, the Fed stopped redemptions and instituted a number of actions over a few days that boosted reserves to at least the level seen in early September of that year. With this experience in hand, we will need to proceed with caution with future securities redemptions. That said, clearly today's balance sheet is elevated and we can decrease our holdings. Should we drain reserves too quickly, we have a new tool to help correct this action should our pace of runoff prove to be too fast again. The standing repurchase agreement facility provides a backstop in cases where demand for liquidity is more than the Fed otherwise thought. Counterparties can come to the facility and obtain financing for their Treasury securities. Now, of course, I do not anticipate reducing reserves to a level where this tool would be used, but it's nice to know that as we move forward, we have additional support available to us that we did not have in 2019. So to close, I have outlined how I see the economy evolving and mentioned several policy steps in the future that underlie that outlook. The tapering of our asset purchases has started and should continue over coming months. Then the Fed will turn to normalizing other aspects of monetary policy as the economy continues to recover from the severe COVID shock we encountered last year. I believe that policy may need to pivot to a faster taper based on incoming data that I will be monitoring. Thank you, and I look forward to your questions.
Thank you very much. Thank you very much for those thoughtful and comprehensive remarks. You leave very little room for questions.
I figured there'd be thousands of them.
No, there will be thousands of them, believe me. Why don't we start by talking about the snowfall?
Okay.
You talked about inflation and that we've gotten a tremendous, if you think about inflation within the construct of snow, a tremendous amount. It was a surprise snowstorm. The inflation numbers have surprised many in the private sector, and they've surprised many at the Federal Reserve as well. There was an expectation that inflation would be transitory and that inflation wouldn't reach the levels that we've reached as well. So it was a timing issue and a magnitude issue that became
persistence.
And a persistence that became such a surprise. Why do you think that this was so surprising to so many?
Yeah, so my view last spring was that, we kind of globally shut down our economies, brought them down, and then we would just bring them back up all together in sort of a synchronous way, that we would have some short delays as we restarted these supply chains. But then by the end of this year, I fully believe that everything would be back up and running. What I didn't appreciate at the time was that, first of all, COVID was not hitting us all exactly at the same time. It was hitting this country here, and this country here, and this country here. So it was in these kind of waves. So it would shut down one supply chain, and as you were starting to bring that one up, it would shut down another supply chain and bring that one up. And then with the Delta wave, you got your supply chain back up, and then it got shut down again. Furthermore, shutting down one supply chain would then affect another supply chain. So it was this asynchronous, more sequential sequence of breaking down supply chains and then trying to get them back that led to the persistence of the inflation and the problems. So that's what I take away from this lesson, is that COVID did not hit us all and we all took care of it and then we came back. It didn't do that. And so we're seeing the effects on the economy. As Governor Claret often says, it's a lot easier to shut an economy down than to restart them all at the same time. And I think that's kind of what we're seeing.
Mm-hmm. What are your thoughts then about when we get back to a more normal level of inflation? When do we get back to this 2% longer term drift point, which is the equilibrium target point? When do we get there, and what factors will influence your thinking down the road that, we're going to get there actually sooner than we all anticipated? Or, and the opposite is, what factors would make you think, it's starting to get a little bit faster than we would have anticipated as a deviation from that baseline?
Yeah, so I do believe that the supply chain shocks will eventually work themselves out, but it's going to take a lot longer for the reasons I just gave. Mm-hmm. So that's going to keep, on the supply side, upward pressures. There's still a tremendous demand stimulus out there. We've all heard about the excess savings across U.S. households. Now, they're not going to go out and blow that in one weekend, but that's still there as potential demand for a long period of time. So we're going to see that. The bigger concern I have, and I think many of my colleagues, is that what we all fear is, if this transitory or temporary, which is maybe a year and a half, inflation gets embedded into household expectations and wage demands, well, once those wage demands start reflecting those inflation expectations, then firms either pay it or lose their workers, and then the firms pass that along to consumers. And this is what we saw happen in the 70s. Inflation expectations were going up, wage demand started going up to keep up, firms then would just pass this inflation along in the higher prices, and this thing just kept going and took off. even though the original impetus may have been gone. Once you get into this psychology of, I expect higher inflation, I need a higher cost of living adjustment, and firms pay it and raise prices, that's when things kind of get lost. And that's what I'm very concerned about. And you're starting to see this in, recently signed labor contracts that now have 10% and then 2 5s. I'm hoping that's productivity, but more likely it's cost of living.
What role does money and quantities play? For example, as you know, at the Center for Financial Stability, we have this Advances in Monetary and Financial Measurement program where we've literally created data that have shown quite clearly, freely available to the public, that monetary emission has increased quite considerably. And those data have been helpful at understanding the twists and turns in both GDP, inflation, and also in financial market movements. Likewise, the Federal Reserve Bank at St. Louis has done pioneering work on money for many years. What role do you think that money and the measuring of quantities, not just money, which you've written about and spoken about in your speeches before, central bank money, but money in the commercial banking system, money that now is being created by cryptocurrencies and the shadow banking system. So we have this proliferation of money. How do we measure it, and how do you think about the Fed measuring the spillovers from central bank money into the commercial banking system, into the shadow banking system, and into the economy more broadly? Namely, what is the monetary transmission of that and the importance of that in thinking about policy?
Yeah, so, back in the 70s, the monetarist, which the St. Louis Fed was the monetarist Fed at the time, was advocating that all this inflation was not being driven by supply shocks, which was the story in the 70s, but by money growth. And that finally Volcker came in and sort of agreed with the monetarist approach that this has gone on for too long, it's got to be these other things. Drove up interest rates, contracted the money supply, killed inflation, and the monetarists won. But by the 90s, monetary aggregates started losing their predictive power over inflation. We've seen dramatic movements in the monetary base, certainly in the last decade, from increasing reserves from QE, and we couldn't get inflation to 2%. So there's clearly been a change in the relationship between the monetary aggregates and inflation that led people to basically abandon looking at them as any indicator of inflation. Now, that doesn't mean that what we're seeing now, which was large increases in the money supply for accommodative policy in combination with fiscal policy, isn't just a standard monetary fiscal demand stimulus, and you're potentially seeing that in prices, and that should continue. But I think any correlation between money aggregates and inflation is really a long run phenomenon. It's not a short-term business cycle thing that you can use very well anymore to kind of predict where inflation is going in the near term. Long term, probably, but not so much in the near term.
Thanks. Can we shift gears a little?
Sure.
You've given a couple of interesting talks on cryptocurrencies and central bank digital currencies. The central bank digital currencies remarks were superb about do we need a CBDC. And then recently, on Wednesday actually, you gave a talk about stable coins and whether or not insured depository institutions needed to issue those stable coins. Why do you think that institutions apart from insured depository institutions should be able to issue stable coins?
Yeah, so what I found fascinating about stablecoins when I first started reading and learning about this a few years ago was I really saw these as equivalent to what economists used to call a narrow bank model, where you would have no lending, you would just absorb deposits, put them in super safe liquid assets, say 3-month US Treasury bills, and then you would just perform payment services for your customers. You weren't doing any credit extension, you were just providing a payment device. You could charge fees, whatever. And this was always viewed since Milton Friedman in the 1950s, this was viewed as a very safe way to run the payment system. So stablecoins have this kind of mapping to that concept in theory, and we all understand that and think there's nothing that particularly dangerous about a narrow bank designed that way. So if a stablecoin was run that way and you could see the assets that they were holding, that they were, say, safe liquid US government debt of 3-month duration or less, then what are you worried about in terms of run risk? If there's a run, they can sell the stuff, pay it off, and you're done. Treasuries are a very deep liquid market. So like I said, this is an old idea. And so there's nothing in there that says these are banks in the traditional sense. That's why we use the word bank, but it's narrow bank. So what I viewed stablecoins was a modern form of a narrow bank that could then provide payment services, potentially cheaper, provide competition to the standard banking system to reduce payment costs, which everybody agrees are too high. So that was my view, is look, this is an outside competitor nobody had ever thought of that's coming in to provide competition. So the President's Working Group paper, when it came out and said, we think they should only be issued by banks, I thought, this is amazing. You've got a competitor to the banks who are going to give that product only to the banks. This just didn't seem like the right way to think about it to me. So I could imagine you could easily set up an entity that runs like a narrow bank. I mean, an example I gave on Wednesday, you could imagine a commercial tech firm, no names mentioned, but you can imagine a tech firm that says, we'll issue our own stable coin, we'll collect dollars, deposits, and we will literally, if you give us a master account at the Fed, we'll just deposit them in the Fed. How safe are these? It's literally like a currency board where you issue your foreign currency, you take in $1 and you hold it in the safest asset it is, in the currency itself. Now, most of us would say, what is the business model behind that? How do you make any money on that? Well, they're not making money the way a traditional bank would do it. They're not trying to get some interest rate spread between what they pay in deposits and their assets. No, they just want your data. They just want your data. They simply want to monitor how you move your stable coin across their network to see how to manage your data and target ads to you, how to send coupons, how to manage merchants' response to customers. That's what they want. They're not interested in some interest rate spread, so they're happy to hold it in super safe liquid assets. Now, that's a private sector competitor that's not a bank, what I just described. It's safe. It's all the reserves are monitored by the Fed. They're held as long as they're not overissuing, right? As long as they're not overissuing and we monitor that, then what's the safety concern? It's a new payment. You may not like who the issuer is. That's a different question. But in terms of creating competition for banks and driving down payments, there's no reason that has to be a bank to do that. Now, it is natural to say, look, we understand how to regulate banks. We know how banks can be made safe. Our commercial bank money is super safe. We never doubt anymore that when I go to get money out of my checking account, it's going to be there. But that's a lot of regulation, supervision, deposit insurance, backstops that have been put in place over a century. Okay, so we can take some of those things and apply it to these non-bank stablecoin issuers and make them just as safe. So,
thank you. And your view on CBDCs, central bank digital currencies. For instance, there's almost this race for many countries to become a reserve currency and question the status of the US dollar as a reserve currency. Not question the status, but compete. Do we need a central bank digital currency to continue to develop technology and to win that race as well?
Yeah, my speech was, I think, very clear. I'm skeptical of this because I look at it this way. Congress gave us the responsibility to have a safe, efficient payment system. With that responsibility, you have to say, what is our role in that payment system? And what we've chosen for over 100 years was that we would let the commercial banks handle the payment system, dealing with households and firms directly, and we would be in the background making sure that the funds flow across banks and settle and clear efficiently. That was what we've done for 100 years. What the question now with the CBDC is, should the Fed take a more active role and step into the business of directly clearing and settling payments with households and firms and compete directly with banks? That's fundamentally the question, and that's what a CBDC allows you to do, an account-based CBDC. So the fundamental question is, should the Fed come in and start competing with private banks? My view is no. Let the stablecoin crowd go do that, right? I want the private sector to compete with private banks to drive down cost. I don't want the Fed stepping in and being the competitor. I mean, as I've used this example many times, but as noble as it is to move to electric cars for climate change and green issues, I don't hear anybody saying the government should produce electric cars to help drive down the price of a Tesla. I don't hear anybody saying that. But why is it with payments we think the Fed should step in and directly compete with the private banks? So that's really the reason. Now, in terms of global issue, if you think about what a CBDC is, it's just a payment account with the Fed. That's all it is. It's not a tokenized digital object like Bitcoin. That is probably the biggest confusion when it comes to a CBDC. It is not going to be a tokenized object. It would be an account at the Fed, just like a bank has a master account. That's it. That's what the Chinese are doing. They're not issuing a tokenized digital coin that can be traded anonymously around the world. They're saying, anybody that wants an account with the People's Bank of China can do it, and you can pay your electric bill. Okay. I don't get how that's a threat to national security. I do not understand how that is a threat to the reserve status of the dollar, because the Chinese people can have $1,000 in their account and pay their electric bill. I don't get it. I've never, but people somehow think it's this tokenized object like Bitcoin that's going to dominate trade. That's not going to happen. No central bank is going to issue one of those things because of all the typical money laundering, illicit finance, tax evasion, all that stuff. No central bank is going to issue one of those things. So it really is, you get to have an account in the Fed and we'll make your payment to the electric company. Really? We can do that already.
Well, you've shared a lot with us, from inflation
Probably
to the
too much.
conduct of, no, quite the contrary. The monetary policy, the balance sheet, growth, it's terrific. Are there other questions for Chris? And please state your name, affiliation, institution, and your question. Howard.
Howard Marks, Oak Tree Capital Management. Thank you in particular for the clarity of your remarks. I think we all understood every word you said, which is not an everyday occurrence. And I was glad to hear you say that the Fed shouldn't be in the business of competing with the banks to provide payment systems. I want to talk about what businesses the Fed should be in. Now, most of us are in this room because we believe in the the free market, and we think the free market is the best allocator of resources. But it concerns me that, as I see it, we haven't had a free market in money in over 14 years. And I believe that rates have been suppressed ever since, I think it was September of '07, when the first big cut was made. And if I were working at the Fed, I would want to get out of that business. And I would want to have naturally occurring interest rates. And I just, and of course, I and many others think that the Fed was slow to raise rates in the last decade. And then when they did it, they ran into a temper tantrum in late 18 and reversed course. I don't know why lower rates were called for under the conditions of 2019, but we got them. And of course, now we have them again. So my real question, I'm not asking for a prediction, my real question is, what is the attitude at the people who run the Fed, like yourself and also the presidents, toward continuous, shall I say, manipulation of interest rates? How about a hands-off policy for the central 2/3 of the time?
So I would say the following. We always have used short-term interest rates as our policy tool, so we've moved that and we adjust reserves in the system to move those rates. We don't target longer-term yields at all, and the 10-year moves around dramatically. So, and we do nothing to step in to try to control the 10-year. So my view, I can only speak for myself, not anybody else, but I look at the 10-year treasuries, that's determined by the global marketplace. That's not driven by us. We're not trying to target it, we're not trying to lower it, raise it. The market is what it is. So the artificial, maybe that's the wrong word, but the kind of low interest rates we've seen is a puzzle to me, is like, why in the world do global investors, why are they happy taking a minus 1% real return on a 10-year treasury? They don't have to. We're not saying you have to. They could sell it off. Okay, so there's something in the world, and we typically, the way I look at it is, this has been the discussion for about 15 years, certainly at the St. Louis Fed where I was, there is a shortage of safe, liquid assets in the world. And because of that shortage, the price of these safe, liquid assets gets driven up and their yields get driven down. So, that's really what the issue is. If you took an economy the size of China, normally they would be an issuer of debt, but they're a sovereign wealth fund. So they're not providing any safe liquid assets, they're actually sucking up all the safe liquid assets. So I don't think that the Fed is trying to do anything in the longer dated market, certainly in the shorter, that's our policy instrument, and that is what we're trying to do. But certainly in the longer dated maturities of the Treasury, we're not trying to manipulate it one way or the other. And like I said, we've seen big movements in that rate over the course of the year, and we haven't done anything different.
Other questions? John.
Thank you. And
Wait for
John Riding. Thank you. Sorry, John Riding, Chief Economic Advisor to Green Capital. Governor Waller, thank you for your remarks, and they're very, I think, refreshing, in the sense that you are taking ownership of some of the fundamental problems on inflation. The Fed laid out a clear framework in August, September of last year on average inflation targeting, and not much more than a year later, we're above an average, if we look back over 5 years, and the numbers have continued to pick up. And I am concerned from a financial stability perspective and an economy perspective that there's this view that the inflation problem is going to go away without Fed policy ever getting tight. So if you look, for example, at interest rate futures, the Fed's long-run estimate on the S&P, 2.5% for neutral rate. And by the way, that's when inflation's at 2%, not at 6.2%. And yet we have no, I'm concerned that if we don't start getting ahead of the problem's going to get ahead of us, and the market's going to have a massive repricing of interest rates. The amount of tightening that's going to be done, what Alan Blinder called in 1995 the stitch-in-time policy, the Fed's gone to the Bunker Hill policy, and possibly even beyond that, in terms of waiting to react. So I want to say that I'm concerned about the interest rate impact, the repricing, and if inflation doesn't fade away, and I don't see why it will to the degree needed, what happens on the policy front?
Right, so part of my comments, that was my example of the snowfall, was back in May, I thought it was going to be 1 inch and gone the next day. It's not looking that way anymore. So just, even if I think this may disappear over a year, I don't think we should be just sitting there watching it happen. That was my whole point of that example. Now, when we adopted our new framework, the problem we were facing was we couldn't, this is a puzzle that for any economist my age, that a central bank can't cause inflation is a mystery, right? But for a decade, we could not get inflation, or almost a decade, could not get inflation up to 2%. So in the 2018-19 time period, we were watching inflation expectations by many measures just drifting down and down and down. And the general concern was the markets are increasingly interpreting our 2% target as a ceiling, and that we have no credibility that we would ever kind of tolerate inflation going over 2%. That under 2 we would do, but over 2 we wouldn't. So the framework was in part designed to try to say, no, we're willing to let inflation run above target if it's run below target for a while. What was so funny is when we were adopting this target, everybody kept saying, you'll never get inflation over 2%. This is a nice pipe dream. You'll never get it over 2%. And then, wow, ask for inflation and thou shalt receive. Boom, it blows through the roof. So one of the things, if you look at a world in which you might be trying to do what's called price level targeting, you just keep a price path on this. We undershot that for 7 or 8 years. We're back. In 1 year, we're back on that price trend. So it was just kind of, I think, more of a combination of events. The pandemic hit right as we adopted this framework. It would be interesting to think back and say, if there had never been a pandemic, could we have had inflation up over 2% for any period of time? That's something we'll never know, but that was really what we were thinking. We weren't planning for a pandemic that would drive all this stuff up. But I think, myself and others are starting to realize that, sitting around waiting for this to disappear is not necessarily the optimal policy response.
Michelle.
Michelle Caruso Cabrera, thanks so much for your remarks. I used to be at CNBC, served on a board with 2 people you might know, Richard Fisher and Dennis Lockhart, but I've since gone into politics.
Central banking wasn't exciting enough.
But it's going to be. So you've rightly spoken about one of your key mandates, inflation today. My question is about your other mandate, employment. The Bronx, which is the borough, you'd call it the county just northeast of Manhattan, at the height of the pandemic had the worst unemployment rate in the country, 24%.
Yep.
And the most recent numbers are still hovering near 14%. And the MCC Personal Beige Book would tell you it's because a lot of Bronxites would get on the 4, 5, or the 6, and they'd come to Midtown and work. And Midtown is still moribund. And so all the service work that used to happen has not come back. To what degree can you give us any insight, analytical work, predictions about work from home, which has really still devastated Midtown Manhattan?
Yeah, this is, like all of you, I thought when this thing hit, we'd be back to work in 6 weeks. And to think that 18 months later, I'm still in St. Louis. I've been doing this job for a year. I've only been to CC like in the last month. I never would have dreamed I could be a governor and never have to show up in DC. But none of us ever thought the technology was there. We could have done it. We just didn't. And it was like, slowly over time, but this hit, and now you're going to have this, most likely, a lot of firms are going to do a hybrid model where their workers are only coming in a couple of days a week and they're going to be home. So let's suppose workers come in 2.5 days a week in Manhattan. That's only half the traffic for food, for everything else on any given day that was pre-pandemic. Well, if that's the world, these businesses are not coming back. Those jobs are not coming back. So, there'll be half as many people coming down from the Bronx. So that's going to require adjusting skill sets, moving into other industries that are growing, certainly on the shipping industry, or not manufacturing, but shipping, warehousing, all of that is booming. So that'll just require a shift in skills and relocation of where their jobs are. But yeah, as far as I can tell from everybody I've talked to, the hybrid model is here. Now, maybe over time, people get back to liking to be in the office 5 days a week. But from now, everything I see is it's going to be there for a while. And so there are a lot of service jobs in core urban areas that may not be coming back.
Colin.
Thank you. Thank you so much for your remarks. I agree with others that they were very clear and cogent.
I got to work on that.
Yeah.
Too many years of being a college professor where the whole objective is to be clear and cogent.
Please keep it up. You're setting a good example. My question is, you made observations about inflation, obviously having substantially exceeded the Fed's target. One hopes at least a decent portion of that really is in fact transitory. But it seems, I'd say, pretty optimistic to assume all of that increase is transitory. And the question I have is that whether I look at the market's expectation for short rates going into the future or the Fed's own dots, that there doesn't seem to be an expectation that the Fed funds rate will ever move into restrictive territory, that it'll ever move, for example, even up to just being a zero real rate, never mind a positive real rate. And so my question to you is, how do you think about that inflation rate, let's say the portion of it, if there is a portion of it that turns out not to be transitory, how do we get the inflation rate back down to target without ever going into restrictive territory?
Right, so if we do our job right, we signal a path of rates aimed at bringing inflation back down. If that path of rates is credible by everyone in this room, then the inflation will taper off and we never actually have to implement it. It's more like a threat. We have the threat of being restrictive with the hope that we never actually have to implement it because everybody believes it's credible and you do it. So this is the whole thing, is it's not just raising the current rate. It's setting an expectation for the entire rate path. And that if that's a credible rate path, then the problems take care of themselves and we never actually have to carry it out. So I know this is crazy, but this is really one of the things that's hard to get across, that this idea that something happens and we have to jack rates up like we did in the Volcker era was because the policy wasn't credible before that we'd take care of inflation. It had no credibility. So this is what is really important from my point of view, is we have to maintain this credibility that we're going to make sure this doesn't last. And that's why it requires us to have a potential pivot now or in the next meeting or two in terms of how we're going to approach policy. Okay, guess my mic's out.
Nick?
Nick Sargent, Fort Washington Investment Advisors. Oh, sorry. Nick Sargent, Fort Washington Investment Advisors. I too commend you for a very wonderful presentation. Let's follow then on the issue of inflation expectations. I think the thing, I am a product of the 70s. I even worked under Paul Volcker. And, then we went through the era of the bond market vigilantes. So if the Fed was behind the curve, we could count on bond investors to react. Today, I'm in shock that, I think they're hibernating after 20 years of low inflation. But then I look now, though, at New York Fed survey of consumer or household inflation expectations 1 year out, 5.7, 3-year average annual rate, 4%. And then you alluded to wages, and we see John Deere. Mm-hmm. And so to what extent then would the Fed be looking not just at Treasury tip spreads, but also focusing on consumer expectations?
Right. So the one thing with the household surveys, and I've said this before, so it's not anything new, but one thing is the household survey is very highly correlated with current inflation. So that, I mentioned that in the comment, that they'll tend to move up and down with inflation. So if inflation suddenly tapers back off, those expectations will come back. So they're almost too correlated with the actual inflation rate and not really telling you what really they think about that. The other issue with the household survey is it's a survey. People don't have any money in the game. So if you ask somebody, what do you think inflation is, and they say 10% until October, I would have said, you're crazy. But there's no cost or benefit to them of getting it right. That you ask them, what do you think it is? 10%. Okay, you're wrong. Whatever. Whereas in the tips market, people are betting money. If you get this wrong, you're going to lose money. So I've always liked the tips market as a better indication of what I should be looking at for inflation expectation, because people actually have skin in the game, whereas the household surveys really don't. Now, that doesn't mean you should ignore the household surveys, because if these households do take that inflation expectation and go to their firm and say, hey, look, I need this raise just to stay up with inflation. And if I don't get it, I'm leaving. That's what I worry about from the household, was when households start acting on those expectations in the form of wage demands. For a long time, these things didn't quite move together. The tips would be kind of anchored, household would be going up, or one would be coming down, and the other one, but they're both moving up. And that's what's got me genuinely concerned. They're anchored out 5 to 10 years, but I'm concerned that that markets don't think we're going to be able to get inflation under control in the next 3 to 5 years, and that's what I want to try to make sure we do.
Next to Nick, yes, please. Name and
Hi, Colby Smith from the Financial Times. So your former colleague, and current colleague, I guess now as well, at the Fed, Jim Bullard, mentioned in an interview earlier in the week that there was potentially scope for the Fed to begin raising rates while the asset purchase program was still ongoing, so before the taper came to a close. To what extent would you support that sequence of events, or do you see it as appropriate for the Fed to wrap up the taper before considering interest rate increases? Thank you.
Yeah, I mean, just from a conceptual level, if you're still buying assets to put more accommodation in and then start raising rates, they don't seem to line up. Now, so from that point of view, I would just as soon end the taper. That could be, if we just went cold turkey and said we're stopping, that might be a shock to the markets. I'm sure it would be. But, we can get ahead of it in sort of accelerating the taper, which is more I've said this for a long time. My preference was to go early and go fast on tapering. I lost the go early part, but we can still go faster. So I'm hoping to win that one. So I think that would be the point. We can, if we were to, like in January, if you do kind of the math from the thing, if you doubled the pace of tapering in January, you could be done by the beginning of April. And then that brings you 3/4 of policy space for 2022, should you need it. I'm not saying we have to, but if you got the taper done, you could have a rate hike, as early as the second quarter of. Again, I'm not saying there's a theoretical possibility and what should be optimal, but at least it gives you policy space, and that's what I've argued for a long time with why you want to get the tapering done faster, so you have more space in terms of interest rates.
Nick, and then Bruce.
Nick Silich, Chief Risk Officer, Prudential. Thank you for the presentation, by the way. It seems to me that we are playing with a set of rules and tools that have been developed over the last 10 years that we've had a central bank in the U.S., and that the world has changed a lot in that period of time, and we still have what are pretty powerful and effective weapons in the short run, but the global imbalances are at a place where they haven't been since post-World War I, maybe post-World War II, but the environment is very different, and the imbalances might even be bigger when you think about the fiscal unevenness around the world, especially the developed world. To what extent do you worry that the tools and the universe that you're playing with and you're in uncharted waters? You talked about the balance sheet of the Fed, how big is too much. Do you guys get concerned that you don't really know what the answers are as you're playing around with all these tools because it's a different world?
Yeah, I always like to point out for any older economist in the group, if in the early 90s I had told you, suppose a central bank quadrupled the size of their balance sheet, what would happen? We would all say, oh, there'd be a massive spike in inflation. Didn't happen. All the central banks, it wasn't like one did it, we all did it, nothing happened. So whatever everybody thought then, and fiscal, if you'd have said a government is going to run their national debt to 250% of GDP, what would happen? Brink of default, spiking real interest rates, crisis in the home country. No, Japan's borrowing at negative real rates. So to your point, what common knowledge would have told us in the 90s just didn't work out. Just didn't happen over the last 10 years. So in that sense, it is humbling that you realize that things may not work out exactly the way you want them to. I was recently talking to market participants talking about bond yields, and he said the SEP is suggesting the neutral rate is 250 basis points. You're never going to get there. I'm like, what do you mean we're never going to get there? I have control over this. He's like, no. He said the real neutral rate's like minus 1%. So with 2% inflation, you're talking about 1% nominal yields. That's as high as you're ever going to get. I thought it was nuts. But then I'm thinking, well, maybe he's right. I don't know. None of us would have thought we'd have negative real yields for a decade on most of these things. And again, this issue about safe liquid assets being in short supply, we issued, I don't know what the federal government issued last year. It's close to $6 trillion in debt in 1 year. And look at what 10-year yields are. I mean, this just seems, if there's a shortage of safe liquid government assets, then all this issuance is just satisfying that demand without having any major impact on real returns. So yeah, no, the idea of going forward, whether rates will ever get back to 250 basis points, will inflation go back down, stay down? A lot of my colleagues worry it's going to go back down and stay back down below 2% again. You know, that it's not that it's going to stay up, it's going to go back down and stay there. So we don't know. We'll have to wait and see. But yeah, no, this job comes with, you have to have some humility.
Bruce had a question.
Hi, Bruce Tuckman, NYU Stern. By the way, I want to echo Larry's thank you for Fred. It's an incredible thing.
I love Fred. It was one of the great joys of my previous job was managing Fred.
So I very much appreciated your comment about there being no model of the optimal size of the balance sheet, although I do find that somewhat unnerving given how far we are from where we've been in the past. And there is, of course, a bad scenario, right? There's a scenario in which inflation picks up, you feel you have to raise the interest on excess reserve rate, and then we lose control in the spirit of humility that you're talking about. It is a scenario, and then the Fed balance sheet really comes under pressure with having to pay the banks a high rate and earning a different rate on the assets. So my question is, at the Fed, are people thinking, is that like so outlandish that no one's worried about it at all? And I understand it's not something you'd want to broadcast so publicly, but are people worried about that scenario as another reason why the large balance sheet is something we have to think hard about because of this, just from a risk management perspective?
No, I don't think that's really in any of our concerns. I mean, if we had to raise short-term rates because inflation was taking off, long-term rates would be going up too, and any reinvestment would be giving us the interest income to deal with these things. Yeah. So that's the thing. I mean, the central bank can't go bankrupt. So we don't mark to market. We can't go bankrupt in any serious sense. So that's in part why we don't have to worry about our balance sheet like a normal firm would. But I mean, I don't think anybody expects, this is back to the earlier question about the whole policy path. If you have a credible policy path that markets believe will take care of inflation, then rates never have to go up and you never run into the problem. The most important asset a central banker has is their credibility. That's it. If they lose that, the game's over. And so that's why it's absolutely imperative that everything we do maintains the credibility in our actions to keep inflation at 2% and to do that within the context of helping the labor market get to maximum employment.
Yes.
Lisa Lee with Bloomberg News. Is there a chance that the FOMC would consider a decision in December to speed up tapering?
I have no comment on that. We just put in place the first one. My own personal opinion was I think it would be something to talk about. But I've said this for a long time. I wanted a faster taper and I wanted tapering done. So it's not saying anything I haven't said for 6 months.
And I think we have time for one more. Jeff?
Thank you. Jeff Young, CEO of Deep Macro. Actually, I like Alfred better than Fred.
That tells you what we actually are dealing with in real time.
Yes, because it's real time and vintage. But no, I mean, obviously they're both very good. I wanted to ask again about crypto. Your comments were mostly about stable coins and CBDCs, which is really about the payment side. But where the action really is in the market is in the coins and in DeFi and distributed autonomous organizations. And so I'm wondering, and that's where the risks kind of, or at least there really could be risk building there. There's a lot of leverage in those systems. And DeFi, by its very nature, is pretty hard to figure out how to regulate because they don't exist. They are networks without organizations, without people. So I wondered if you could just comment on, on that side of the crypto street rather than just the payment side.
Yeah, so I've started to look, my best friend and co-author has been into this for a long time, and I learned most of my stuff from him. He actually does daily DeFi trading and stablecoin arbitrage, or crypto coin arbitrage. So, if you think about Bitcoin to me is basically electronic gold. It's an asset people buy, they hope it goes up, but it can go down. No one's promising you a rate of return. It's kind of it doesn't have any fundamental intrinsic value, but that's okay. We've known in economics since 1958 that useless objects can have value. I mean, this is not hard. As long as you believe somebody else will pay you down the road for this, you'll pay it now. Look at baseball cards, look at art, look at Beanie Babies. There's all kinds of things. That's all these crypto assets are really replicating to me at this point. So you can issue it all you want, and if nobody ever believes anybody else will ever take it, it'll have a price of 0, which most of the 6,000 crypto coins have a value of basically 0. Once in a while, these things will pop. And once they pop, if you think it's going to continue, then they can sustain themselves. So that's the thing, is the crypto, you can't stop it. Anybody can issue these things, but most of them have 0 value, so they're not a threat to the system. Once they pick up, then they become like electronic gold. They're another asset you can choose to hold. You can choose gold or Bitcoin. I don't care. We don't sit there and worry about gold prices destabilizing the financial system per se. So in that sense, I don't really worry about crypto assets too much. If they pop, you lose your money, poor you. And that's the risk you took when you bought the thing. So I don't think we'll ever see, or I hope we don't see, that governments step in and backstop these things any more than we backstop the price of gold. We don't do that. So that's a credible thing where we don't backstop it. If it goes up, you gain. If it goes down, you lose. Same thing with crypto assets. DeFi to me is another fascinating thing. I'm actually going to be giving some talks early next year on crypto and on DeFi. The DeFi network's fascinating because of what you said. It's a decentralized network. There's really nobody running it. Trading is occurring. Smart contracts are amazing things that you can do pretty impressive stuff with. There's instant clearing and instant settlement. You want fast clearing and settlement, put a smart contract on the Ethereum network. It'll settle and clear like that. So I think it has actually a lot of potential for trading going forward. I don't know how to do it. I'll ask my buddy how to do it, and he'll tell me. But everything I learn is from him is, this is not going away. This is an amazing tool, and that more and more market participants. Now, if that happens, then you're going to get more regulation coming in to protect customers from getting taken just like any other security or intermediary that does things for you. So I think as it broadens and there's more use by institutional firms, there'll be more the regulatory control put on how things are done, what sort of protections, what needs to be there. But I think it's a fascinating product, and I don't know how you stop it. Again, you can't suddenly say, I just want to eliminate DeFi. Doesn't work that way. It's out there, it's done.
Governor Waller, thank you very much.
Well, thank you for all.